All right, so in this episode, what I want to share with you is how do you be bullish and bearish on a position? You might be wondering, why might you do something like that? And there's a couple of good reasons. Stay tuned. All right, so if you believe in a certain stock or company and you think over the next maybe 5 years it's going to continue to go up or appreciate, you might say, hey, I'm bullish. And in that case, you believe in what's going on with the company. You believe it's going to appreciate. But this last month or the last couple of months, the stock has been performing poorly or it's been selling off. And in that case, in the short term, you might be bearish. So from a short side perspective, next couple months, they're having some issues, they're having some trouble. But in the long run, in the next 5-10 years, you're looking, hey, it's going to do fine and well as a long-term investor. So as we look at something like this, you might say, okay, well, looking at FedEx, this thing continues to appreciate since 1987. And then recently, though, we've been kind of pulling back. So if you're thinking, hey, on the long run, I think it'll be fine, no big deal. But recently, the last couple months, it's been struggling. Well, in that case, you might say, well, let me set up some positions where I'm short term, I'm bearish, but in the long run, I'm still kind of bullish. So there's a lot of ways you could do that. You could do this also with stocks like maybe Twitter. So you could see, hey, I'm going to be bullish in the long run, but recently it's pulling back, or even stocks like Facebook as well. So take a look. So in the long run, this stock's been kind of appreciating since 2013, so it's been kind of going up. But recently, over the last couple months, this stock's been pulling back. So how would I set up a position to be able to trade something like this? Well, here you go. So here is something that we could do, and we can go into Facebook. And what you could do is set up a position where in the short run, you are bearish, but in the long run, you are bullish. So let's say over the next 30 days, I am bearish, but over the next 2-3 years, I'm bullish. So first off, most people, what they do is they start off with just the stock version. So let me show you the stock version. And what you're doing here is, let's say you had 100 shares of stock right here. So if you had 100 shares of stock, you're basically bullish in this case because you want that stock to appreciate. You have 100 shares, which is 100 delta. So you have hard delta. So as it goes up, you make, for every $1 move up, you make $100. Okay, and that is what the delta tells you. Okay, so now if I say, okay, well, on the short run, this thing's been pulling back. How do I start protecting myself? Well, what you could do is, rather than buying a put, you could also say, okay, in the short run, why don't I go in and sell a call? So in the short run, this would be a single. Now, if I sell one kind of at the money, in the short run, I'm kind of bearish, right? Because I've got these shares, and I've got these shares maybe about 30 days out. Now, you could do less days if you want, but let's say about 30 days out, and I'm looking for this to pull back. So I have negative 33 shares. So I have my 100 that I'm kind of plus, and minus 33 delta. So that kind of gives me a net of about 77 shares that I'm positive. But I also make $24 a day from Theta. So at expiration, I get to make about $630 of premium, which is that number right there. And that is at expiration. So in total, when you combine it, there you go, 66, sorry, my math is off, 66 plus that 33, you get that 100 shares or 100 delta, and that's how the numbers work out. So in either case, we're looking at this from the long side. If I'm holding this stock forever, or let's say 5 years, but this option over here, I'm just holding for maybe 30 days. So on the 30-day time frame, I think it's going to go down. From a 5 years, I think it's going to go up. And that's one way to kind of make some money off of it. The other thing which you could do is, let's say you're just dealing only in the options world or on the options side. So how would you do something like that? Well, let's say 100 days out, I might have a vertical that I've bought. So let's say you get this vertical, and you've got, let's go with 10 contracts here. So if you're dealing with verticals here in the long run, for January, I am bullish in this case. But what I could do is, in the short run, go to about 23 days out, because maybe the next month it's still going to be acting weak, and I can sell verticals against that. So now as I analyze that trade, let's say I sell like 6 of them. Okay, so you could see, hey, in the short run, November 5th, I am basically bearish until that point. But anything after that, I'm bullish. So November 5th, in my case, is about 23 days out. Okay, but in the long run, I'm still kind of bullish. So this is how you set up these trades where, hey, part-time in the near future, I am bearish. And this way you don't lose as much. And in the long run, you're still bullish. So that way, this bearish trade makes up a little bit of the losses that you'll probably get from being a long investor. So that's kind of what's happening is that, okay, so let's say normally in this vertical, you might say, okay, well, if this thing goes down, let's just say it goes down all the way to 0. So you lose $3,650. That's your max loss. But if you sold against it, okay, well, you're making back 680. Okay, so you're making 680. So instead of losing the full 3,600 or some, whatever it is, 3,650, you're making back some. So your max loss is only 2,970. So you reduce your loss by about that 680. So that's nice if you can keep reducing your losses. And that's really the point, is that short run, you're bearish. And you could be more bearish on the short run, like how heavily bearish are you? And that would allow you to kind of reduce your losses even further. But keep in mind, if the stock does snap up, you might actually lose out more on your short-term play. So that's kind of how you could be bearish and bullish at the same time. But just understand that there's two sides to every coin. If you're very bearish in the short run and it goes against you, it can actually, it creates a loss. So that becomes a bit of a problem. So I hope that helps and gives you some thoughts to think about, that you don't have to be fully bullish all the time. You could be bullish in the long run, okay? But in the short run, you're bearish. And that just helps make up some of the losses that's going to happen as the stock is pulling back. It doesn't matter which stock it is. Just like FedEx here, even if you're bullish long run here, and then all of a sudden you see this, hey, I got to start protecting my position. So you start doing some shorter things where for a little bit you're bearish, and that could help ease up some of those losses. So that way those losses are not as bad or nasty as they could be. So anyways, thanks for joining me in this video. I hope you got something out of it. Grab some of the freebies that I have on my website at tradersfly.com. You can click the link here or in the description, or if you're on our website already, just go to the freebies section. There's a lot of great like mini courses, PDFs, checklists, and that kind of stuff as well. Thanks again, and I hope to see you in the next episode.